10 market themes for the third quarter of 2023. So I put together this slide deck, just kind of going over the things that I'm looking at, what the themes are. So we'll just kind of jump right into it. Looking at valuation on securities, what's driving the markets. With interest rates as high as they are, how has that impacted investments as far as comparing cash with bonds, corporate bonds, and equities? We'll kind of hit on a lot of things. Then the last chart that's not on here, I threw it on. I've been getting questions, of course, about the debt downgrade, where one of the rating agencies downgraded the U.S. debt to AA instead of AAA, which happened in 2011 when they had the debt ceiling stuff going on at that time. But then I'll kind of talk about the long-term impacts and what I'm kind of looking at when it comes to our deficit, the amount of debt that we have, and what that will look like going out long-term, not this year or next year, but going out years from now. So we'll kind of just jump into it. So you've seen on the headlines, you know, the S&P's had the second best start to the year since 2000. 2019 was a little bit better. But what's driving these returns? You know, we invest in the S&P 500, but we don't put all of our money in, you know, just the S&P 500. We diversify amongst emerging markets, international commodities, you know, a bunch of different investments. But this is what's driving it, and this is what people hear. But here's the main discrepancy, what I call market breadth. It's like, how's everything doing as the economy, stock market in general, versus what the indices are saying. So the first thing I'll tell you is that the S&P 500 and the Dow Jones are indexes that the S&P is based on market cap, which just means how much a company's worth. So you just take their stock price and multiply it by the number of shares outstanding. That tells you what that company's worth. So the higher their market cap, the more weight they have in the S&P 500. So it's a market cap weighted index. The Dow Jones is a price weighted index, which just means the higher the price, the higher the weighting. And there's only 30 companies in the Dow, there's 500 in the S&P 500. So you can see that you have this 15.9% for the S&P, but if you look at the underlying stocks, the other, you know, 250, this is just looking at the other half, then it shows that they're only up like 3.8%. So what's driving that? And here's the main driver. In my commentary that I just put out this last week, I talked about the FANG stocks. Well, that's the acronym. It's no longer relevant because Facebook changed its name to Meta, Google changed its name to Alphabet, but we'll still just call them the FANG stocks. And there's a couple added, Tesla, Nvidia, but these 7 companies make up 27% of the S&P 500. So a little over a quarter of the weighting goes to just these 7 stocks. So that's what's driving the returns. You have 493 other companies that make up the other 75% or a little bit less. So these drivers, like Apple, Microsoft, are all kind of tied. You know, you can think of them just like the internet or the dot-com bubble, but they're driven based on AI. So especially NVIDIA, these AI type securities. When you look at the valuation, it's getting pretty scary on these AI companies. I mean, especially like Apple, they're coming out with that new, I can't remember what it's called, but I watched they're doing, it's going to be pretty neat. I mean, I don't see how applicable it'll be unless you don't want to watch TV, but you want your entire wall to be a screen or your entire vision. But that's their next product. And a lot of it has to do with AI. But when you look at a company like Apple and look at its price to earnings, which we'll get into that in just a minute, but that's a multiple. And it's always traded in a range around, 12 to 17, and now it's around like 50. I mean, so that just means that the price of it has gone way up relative to its earnings. But when you see a weighting like this, it's always a little bit, should put you on guard to say, okay, like, are these companies going to continue to grow at this pace? Because if you look back at the tech bubble, I mean, there were stories of companies like a dog food company that would just call itself dogfood.com, and then its stock price would just explode. People were just, anything that was related to the internet, it was going to change the world, and it just got ahead of itself. The NASDAQ went up hundreds of percent in the 90s, only to lose 80-some% of its value over the 2000 to 2003 period. It then took over 20 years to break even. When you look at AI, is it going to change the world, change the way we do things? Sure. I just don't think it's going to happen overnight, just like the internet changed everything for all of us, but it didn't happen overnight. It was just a slow progression. And so when I look at these statistics and say 27% in just 7 companies, whereas the overall market breadth isn't doing near that well, then that tells me that more than likely we're going to see these come back down. It doesn't have to, but that's typically what happens. Then when you look at like valuation, so again, the price to earnings, the little bar chart there on the right, it shows growth stocks are up 5.9 times on their price to earnings. So I know there's a lot of jargon here, but let me kind of unpack that for a second. So a price to earnings is just, you look at a stock price and then you divide it by the earnings, and that'll give you a multiple. And what that tells you, if a stock has a price to earnings multiple of 10, then you are willing to pay $10 for every $1 of earnings. Okay? So, and when you see a multiple expansion, that just means that the price to earnings has gone up. And when you see growth stocks at 5.9 times, then that tells you that the price has gone up 5.9 times more than the earnings. So you've seen this big multiple expansion. And you don't typically want to see that if you're in a robust economy and everything's doing well. That's just telling you that a lot of money's chasing those same amount of earnings and bidding up that price. So if you look at your more conservative, like dividend paying stocks, low volatility stocks, value stocks, all that is still, a half a times. Not even 1 times increase. And so of course they haven't done near as well as your growth stocks. But again, it's just a way to look at it and say, well, the overall economy, if you look at everything, it's really these growth stocks and these mega cap tech companies that have been driving this rebound in the stock market. The chart on the left looks at it where it is today versus where it is, like its 10-year median, which is the middle of that range. And so you can see the growth stocks are way outside of the range. And this is that little box is the 80 and 20th percentile range. So it's way outside of that. And then if you look at mid caps, high dividend, low volatility dividend growers, those are all actually trading below. So those are the ones that are, you would say, at a better valuation, but they just haven't done as well. And again, most of that's been driven just by multiple expansion, people paying more for the same amount of earnings. So go back down this way. So where does that put us when we look at interest rates, cash returns, which are like money markets, treasury bills, versus bonds versus stocks? So if you want to compare a stock to something that has a fixed income like a bond or cash, money market, then you just take the inverse of the price to earnings. So you'd look at earnings divided by price, and that'll give you a yield on those earnings. And then you can kind of look, well, are stocks yielding more than bonds? Now the answer is they're all yielding about the same. So you can look at money market accounts that you can get close to 5% on. Bonds you can get about 5% on, 5.5%, and the earnings yield is about 5.5%. So this puts you in a situation to where a lot of people will look at it and say, well, I can forego any capital gains, stock market, rising, and then I can just buy a money market or buy treasury bills or other types of bonds and hold them to maturity. And if it's a money market fund, then it's in perpetuity. But if rates do fall, money market yields will come down. But if you lock in a bond for say 2 years at 5%, then you're going to get 5% for 2 years and then get your money back. So a lot of the times this puts a headwind to stocks because a lot of people will start rotating out of stocks and holding a more money market type funds, which is most of our portfolios. As you've noticed, we have money markets inside there. So, and we have a higher weighting in that. And that's based on this. So when you look at is the risk worth taking? And for a lot of people, if you're a more aggressive or moderate aggressive type investor, then it's like, yeah, the capital gains are there and we're investing over a long period of time, not just, the next year or two or till we see an easing cycle. But you can actually allocate more into a cash-like investment or money market bond type investment and still generate returns, whereas in the past, for almost a decade, that was darn near impossible. I mean, everything was just yielding so little, and inflation was actually above most all those interest rates as well. And that's the same thing. So interest rates have come down, have gone up, but inflation has started to come down. So right now, you're actually earning more than inflation, whereas last year it was the opposite. I mean, you had 8-point-something% inflation, and bonds were still yielding like 3 and 4%. So inflation was eroding that away. And right now is a time to where if inflation stays down, then you'd be able to earn a little bit more. So it's just a way to look at risk reward versus stocks versus bonds versus money market, T-bills, and those type of investments. So this is a little bit dated because they did pause in the June meeting. Interest rates went up 5% in 15 months, one of the fastest interest rate rises in history. And then they went ahead and raised it again. So now we're at a 5.5% Fed funds rate. They did that in July. So, but you can still see that in only 15 months, it takes at least 12 months, most of the time even longer, 12 to 18 months, before you actually start seeing these higher interest rates impact the economy. So we're starting to see that a little bit. We'll see another slide here in just a second. But for a pace that fast, and yeah, we did see a big sell-off in 2022. Most of that was in those growth stocks. Growth stocks were down 30-some% last year. The overall stock market was down 20% last year. So, but that was more of a reaction trade, in my opinion. It wasn't really that those interest rates have impacted the economy. It was just the anticipated impact that they were going to have. And now the markets have started to price in rate cuts and a Goldilocks scenario, which could happen. But if it doesn't, then you'll start seeing that those valuations and things come back down towards reality or towards what the actual economy is doing. So this right here is the economic data. Let me just pop this over. There we go. That makes it a little bit better. So this is looking at the economic data. So this is LEI, leading economic indicators, as well as the coincident economic index. And so I went back to the 60s, and you can see that any time that we've been in a recession, going back to the 70s, we've seen the leading economic indicators fall below zero. And so each time that's happened, you don't know when it's going to stop as far as how low that index will go before you see a recession. But the other key is the coincident indicators. So coincident indicators are just the present situation. Leading economic indicators are ones that are looking towards the future, kind of like industrial production and things like that. But you'll also notice that each time we had that you eventually saw the coincident indicators, the present indicators, actually go below zero. So we're not there yet. We may not get there. We may see the leading economic indicators bounce out of here. But so far over the last, 50 years, that hasn't been the case. But this data is non-normally distributed, so it very well could happen. But my base case is still that we will see a recession. I've had to push that out because of the data that just came out, especially even this week. We saw unemployment go down again. Now it's at 3.5% unemployment rate. Wages went up, which again doesn't bode well for the inflationary picture. But at the same time, productivity went up. Productivity jumped like 3% in this last month. So remember the simple equation that I gave you, that wage growth or income growth minus productivity growth equals inflation. So you can definitely see inflation continue to come down and wage growth stay higher if productivity growth starts rising. But it's been negative for several months, and we had this big productivity boost just this last week. So will that continue? It's just one data point, but I'll definitely keep an eye on it. If it does start to improve, then I'll definitely change my base case to say inflation is coming down and we will likely see a great economy, because if productivity is increasing and people's wages are increasing, which means inflation's stable, then the economy should do really well. Again, at this point, it's not my base case. And you can see that we still got a ways to go for the coincident indicators to come down as well. So this is bankruptcies. So you can see 2008, that's what happens when you have a big recession. 2020 wasn't near as bad because it was so short-lived and businesses got tons of money. But you can see that we've now broke above the 2006 median, which is 540 per month. We're at 591. This was March of 2023 because the data is reported it's either quarterly or semi-annually. So this is the latest data on it. But we want to monitor and see, because you can see that in 2008, bankruptcies, they started climbing pretty rapidly towards the end of 2007, going into 2008. So if this continues, then that would be a sign that the economy is definitely suffering more than anticipated. And this chart just looks at high yield bonds versus your investment grade bonds. So there's a huge spread there right now, and typically that's associated with when you see that big widening, that the economy's not doing that well. And then whenever they squeeze together, get closer, then that means people are more willing to take the risk to own these higher yielding securities. But it's just what I keep an eye on, especially in the credit markets, is look at the spread between junk bonds or high yield bonds and investment grade bonds. And that'll give you a sense of what the overall market is actually anticipating. So they're definitely requiring these people. Junk bonds are just heavily indebted companies, so they're requiring them to pay a lot more to access credit markets. And this is just one of those charts that it doesn't really make a whole lot of sense to a lot of people, but to me it's a way to look at how the overall economy and what the consumers are thinking. So you can see in 2020, this is TSA, so this is how many people are traveling at checkpoints, right? So flying, traveling. My wife, she's a traveler. She loves to do that kind of stuff. So, but you can see it dropped off a cliff because everything was shut down. But you can also see that the consumer, and that's what the data tells me, is these higher interest rates have not impacted the consumer as much as they have certain businesses. So the consumer so far is still fine. Unemployment, like I said, is great, which bodes not so well for the Feds to start cutting interest rates. But what that tells you is if the consumer's doing well, 70% of GDP is based off consumer spending. They got tons of money during COVID. Savings rates are really low right now. That doesn't mean they're out of money. That just means that they're saving less. So people, if you look at the sidelines of what's in actual money markets and the SLOOS report that comes out, which is Senior Loan Official Report, then you'll notice that people are starting to pull in and dip into their savings, but they still have a lot of money in their savings. So consumers are still doing well, and that bodes well for the economy. But those typically turn pretty quick. Consumers, when they start sensing that they might lose their job, savings rate starts going up, and they start spending less. But this is just one of those odd data points that I like to look at to just kind of keep an overall picture of, well, are people still traveling? Are they? And these are not so much just spending on necessities. This is spending on what they're wanting to do. But here's the one that I just kind of threw on at last minute. Didn't have time to do all the nice little pretty formatting to it, but I just pulled it off Bloomberg because most people are aware that the U.S. got downgraded. And so when you look at this chart, it's just, it's mind-boggling to see that the U.S. deficit is now at $1.392 trillion. And their outlays, what the government's having to spend, has continued to shoot up. That data point is going just to 630. We had new data come out on the outlays. It's actually at 910 billion. So almost $1 trillion in outlays and $1.4 trillion deficit. And so what does that mean going forward? So the government, if this was your balance sheet, if this was you, you'd be in a lot of trouble, right? If you're spending way more than you're making, your deficit or what you're owing people is this far off. The only way to reverse it is to tighten your belt, spend less than what you earn, pay off your debt. But the government has this great ability to just print money. But right now they're in a tightening cycle. So the only way they can fund a deficit is to raise taxes, increase their revenue that way, or they're going to have to tighten their belt to decrease the deficit, or decrease their outlays. So or inflation. And inflation, I won't get into that, but inflating away debt is one thing, but that's a devaluation of a currency. So the other way to fund it is they can issue debt, and that's what they have to do. So when you have a big deficit, you have to issue more debt in order to cover that deficit to continue spending. So if there's not enough demand, which means there's not enough people willing to purchase it. So we've already know Japan slowed way down, China slowed way down. There's a lot of talk about other countries using like China's currency or diversifying their currencies away from the dollar. None of that's impactful at the moment, but they have to issue debt in order to fund their deficit. And if there's not enough demand for it, then rates will go higher because there's too much supply of debt, not enough demand. If that occurs, and we've seen this in history in several different countries, but it's been a long time since we've seen it in the United States. But what the federal government will do, or the Federal Reserve, they'll just step in and buy those. So the government needs, $1 trillion in debt issuance, and there's only, 900 billion demand, which means foreign countries, banks, investors, the demands at, say, 900 billion. Then the Fed will have to step in and pay or buy those other $100 billion in bonds. But if they do that, that is a form of yield curve control, which is what Japan is doing right now. Their central bank just said, we're going to keep the 10-year rate at 0.5%, and we're not going to let it move from there. So no matter what, if the market starts forcing rates up, we'll just step in and buy those bonds in order to push rates down. So we won't do yield curve control necessarily yet, but if they step in and start buying these bonds, that is providing liquidity to the market because the Federal Reserve buys those bonds from banks. And so they'll put more money in the banks, which gives them more power to loan money, which loan demand was down. That's what got these SVB and these other banks into trouble, was there wasn't enough loan demand for all their deposits, so they went out and bought treasuries. Yields went up, bond prices went down, so now they're underwater 30% on their bonds. But the Federal Reserve will step in and purchase those, providing liquidity, which also doesn't bode well for inflation. And again, these are long-term, long cycles. So even if they stepped in and started purchasing it now, you're not going to see that in the inflation numbers for probably 12 months. But it's something that we want to keep an eye on, because if we do see the Federal Reserve start stepping in to purchase those, then that'll tell us that inflation's probably going to be a little bit more sticky, and it's going to be a lot harder for them to get it down to their 2% target. So then again, you're looking at anything that's got an inflation type hedge to it. So those are the themes that I wanted to talk with you guys about. And as always, if you guys have questions, feel free to give me a call. And hope you have a nice weekend. Enjoy the cold front coming in on Sunday, because I'm about to leave here and melt. But have a great weekend, guys.